So this video will be one of the most important videos that we will be making because it represents the primary complement to our DCS approach. Combining this with the DCS is a very powerful combo that can help build our precision, meaning our hit ratios as a trader, and more importantly, from my own experience, it maximizes our ability to hold on to our winners because it gives us a framework on how far a potential move could go. This primary complement is called the Fibonacci or the Fib framework. And its simple essence is this: every single part of the cycle, whether it's the uptrending part, the bull market part, or the bear market part, can be gamed out in advance using specific Fibonacci or Fib numbers that we will be using as guides. Before we start, I'd like to highlight and emphasize that the Fib framework is what we use to guide our focus every time or every moment that we're trading. It is essentially what we use to validate or invalidate where we are in the cycle and what kind of patterns are currently unfolding. Let's begin. So the first wave in an Elliott sequence is called wave 1. Wave 1 pretty much starts every single cycle or even every single bull market regardless of the asset class. Wave 1 begins as a 5-wave structure, and it is used as the basis for gaming out or measuring the succeeding waves in the Elliott sequence. After wave 1, we now enter wave 2, which is a 3-wave corrective structure. Now, it's important to note that because the bull market is just starting out or the cycle is just in its infancy stages, sentiment is primarily negative, with only a few institutional or smart money interested in participating in this particular asset. And because sentiment is primarily negative, you will see from backtesting wave 2s throughout history, at least in the US market, you will discover that 88% of all wave 2s come in the form of zigzags, while 12% only come in the form of flats. Now let's examine how those two differ in terms of structure and Fib relationships. A zigzag is a 3-wave corrective structure that we can label as ABC that typically retraces from the 50% to the 618% Fibonacci support. Now, it's important to note that inside this 3-wave structure, the wave A of the zigzag will first retrace to the 236 or 382 Fib support. And then after that, you will have a B wave counter rally that will retrace at least 50% of the previous A wave in the zigzag. And then finally, to complete the zigzag, you now have a wave C that will pull back or retrace all the way to the 50% or the 618% Fib retracement level as it relates to the previous wave 1. And for flats in particular, which are only 12% of wave 2s if you historically backtest it, it also follows a 3-wave structure, which we can also label as an ABC. But the difference is that an A will typically pull back to the 236382, same as a zigzag, but here's what makes it different. The B wave of a flat will retrace all the way to the beginning of an A, sometimes even exceed the A and reach the 1.236 extension. After that, it will have a C wave that will complete the flat, which will bring it all the way back to the 236 or the 382 fib support level, typically reaching the same low of the A wave inside the flat. Now, the most important part of the Elliott sequence is wave 3. It's important simply because this is where most of the money or most of the wealth is generated. To us, Open Journal, it's important because this is where we will be focusing on, or this is where we will be specializing in terms of the opportunities for subscribers. While we will be laying out the full parameters of the system in the next episode, let me lay out here the fib relationships that we observe when we are trying or attempting to ride a wave 3. In relation to wave 1, a wave 3 advance will typically travel to at least the 1.618 extension, to the 2.618 extension, and as high as even the 4.25 extension and beyond. What do I mean? Here are the historical backtest statistics, at least for all advancing wave 3s in the US. For wave 3s in particular, price will travel to the 1.618 fib extension in relation to wave 1. That happens 45% of the time based on history. 30% of the time, wave 3 will exceed and even reach the 1.618 to the 2.618 fib extension in relation to wave 1. Now, less than 8% of all wave 3s will exceed the 2.618 fib extension and even hit the 4.25 Fibonacci extension in relation to wave 1. All in all, it is the 1.618 fib extension resistance, the 2.618 fib extension resistance, and the 4.25 fib extension resistance that represent around 80% of all the distances traveled by wave 3. And this is precisely why we want to focus on wave 3, simply because it represents the longest runway for us to hold through an uptrend. After all, it is not in the buying or the selling that makes us the money, but rather in the holding and the sitting. And since wave 3s represent the meat of any up move, of any bull market, then that is precisely the opportunities or opportunity that we simply want to focus our trading capital on. While we will be discussing more of Wave 3's intricacies in the upcoming town hall and even in the next episode, what I will say from experience is that every time you have a Wave 3, it is always what shifts the general sentiment from negative to positive. Why? Because simply nothing changes sentiment more than prices going higher and more people making money. And lastly, I will also say from experience that it is during wave 3s that I always observe the fundamental catalyst to start to become visible, whether it's earnings growth visibility or whether it's a particular event driven or speculative play that becomes visible. Either way, it is during wave 3, the advancing phase, that majority of the discounting happens for that particular catalyst in play for the company. After wave 3, we now enter wave 4, which is simply defined as the last base before prices make that one last surge going higher, which typically ends the overall up move. And what you need to understand is that since we came from a wave 3, which typically makes sentiment positive, wave 4s are typically shallow corrections, which means that more than half of the time you will see and observe that wave 4s usually manifest itself in the form of flats. Flats are three-wave corrective patterns that typically end at either the 236 or the 382 fib support as it relates to wave 3. To detail how a wave 4 flat looks like, you usually have a first leg down, which we will label as wave A, which usually hits the 236 or the 382 fib support. And then you have a B wave, which typically rallies all the way to the beginning of the A. And then after that, you have one last leg down, which brings it also to the previous low or to the 236 or 382 fib support where the low of the A was made. Now, this kind of flat happens more than half of the time inside wave force. Lastly, I will say that outside flats, you also have triangles and zigzags that happen in wave force. These are a minor probability, and these kinds of patterns usually exceed the 382 and typically reach the zero point 0.5 or the 0.618 fib support as it relates to the previous wave 3. The final part of the Elliott sequence, or the uptrending part of the cycle at least, is wave number 5. And wave 5s are pretty simple. Assuming that we have an extended third wave, that means you have a third wave that goes to the 1.618 extension and beyond. That means that wave 5 can be measured simply in relation to wave 1. That means that wave 5 will either be equal to wave 1, 1.618 times of wave 1, or 2.618 times of wave 1. Either way, wave 5 will typically end in these resistance levels, and that pretty much ends the bull market or uptrending portion of your Elliott wave sequence. Now, it's very important to note that at this particular part of the sequence, sentiment is the most positive that it is in the whole cycle. That means every single Tom, Dick, and Harry, or every single Tito, Vic, and Joey will pretty much be telling you to hold on, even more so to buy more shares. And that's why it's always very hard to get out at this portion of the particular cycle. From experience, This is exactly where hope is the hardest to actually deal with, which typically comes at the expense of actual clarity, which originally should come from your system and not your emotions. Now, there is one other scenario that we also observe in wave fives. This alternative scenario only applies when wave 3 is not extended. That means your wave through is less than the 1.618 fib extension. Should this be the case, then how you measure wave 5 should be in relation to the size of the beginning of wave 1 to the end of wave 3. If you take that distance, then you will discover that wave 5 will fall between 0.618 extension to the 1 extension or the 1.618 extension of the distance traveled from the beginning of wave 1 to the end of wave 3. This particular scenario is often observed in the commodity markets or even in relation to commodity related stocks. Now that ends our Fib framework episode. We hope you can refer to the town hall videos as we discuss examples, multiple examples on how this framework applies to different examples here and abroad, and of course, across multiple asset classes.